Greetings. Happy New Year. We are at the end of a week, at the end of a month, and at the end of a year as of Friday, December 30. Hi, I'm Ben Reppond. Welcome to my YouTube broadcast. Today is January 4th as we step into the month of January 2023. I'll begin with the dashboard. The dashboard covers 4 U.S. indexes, major indexes, 2 foreign indexes, ETFs, and then 1 government long-term bond. And the dots to the right are the degree to which, if they are these ETFs, indexes if you will, are above their 20, 50, 100, and 200-day moving averages or below. It's not a, it's more of a lagging piece of information or a lagging indicator. It's not a forecasting tool really. But it's a snapshot to show you where are we from many perspectives. U.S., large cap, small cap, growth, value, foreign, developed, undeveloped, and government bonds. I mean, you really hit a broad spectrum of assets. And so you can see by looking at all of those that, the vast majority are below their moving averages. The ones I focus on are SPY, the S&P 500, which is the third one down, and then the last 2, which are the TLT, which is a long-term government bond, 20-year government bond, and QQQ, which is the NASDAQ 100. So the reason I focus on SPY is that it is typically a benchmark index, and it has value stocks and growth stocks in it. So it's a little bit of both. It's a good benchmark. The government bonds are interesting because they make up, or some version of them makes up, the 60-40 portfolios, some kind of allocation of stocks and bonds that investors have. Equity risk is usually too much for most people, so they put bonds together with that. And this is interesting because bonds for this year, and this has been going on for quite a while, this year are down 32%. I think I did a calculation, and I think the long-term government bond from its high in the last couple of years is down 47%. 47. Wow. And that has been the cornerstone of protection for equity risk in traditional portfolios. And it just keeps going down. And you may want to think that that investors have anticipated this, that some of the interest rate hikes are baked into the price, and they may be. But it's interesting, it's just not getting the memo. It just keeps going down. And then growth stocks are down 33%, NASDAQ 100. And then small cap growth is down 21. What's interesting about this is that what was on top a year ago, about a year ago, were growth stocks, at least a year and a half ago. Growth stocks, NASDAQ 100, what's on the bottom? That was on top. And a lot of companies, individual stocks were doing well. You remember FANGs were talked about. You don't hear much about FANGs anymore. And Facebook, Apple, Amazon, Netflix, Google. And so people were heavily invested because they were, I hate to say they were chasing those, but they were favorable. Why would you not want to be invested in growth companies that were doing very well? So some portfolios maybe had more, some had less, but I think a lot of portfolios included them. from their high, and most of this is this year, not just the growth stocks, but the growth stock that was the growth stock of all growth stocks was the ARK Innovation Funds, and ARK-K, ARKK, is one that's most commonly referred to, but there's several of them. That is down 78%. Innovation companies. Netflix down 75%. Facebook and Tesla down 68%. Amazon down 52%. Apple and Microsoft are only down 28%. Last week, I played a piece by Chris Verone in his interview on CNBC, and he kind of unpacked what's going on with Apple. And he said that Apple, he believes, is the last one to fall. Now, it's down 28%, but relative to some of its peers, it's done very well. It's considered one of the best companies in the world, but it's down 28%. He says, I'm using his numbers here, that it's probably from here going to drop down to about a 44% loss before it starts to recover. It's not done declining. That's Apple. If that's true of Apple, what about the rest of the companies? When I break the S&P apart into its 11 sectors, these are the 11 sectors. Again, I'm using the 20, 50, 100, and 200-day moving averages, and you can see some are above, none are above all four, but some are above three, and then, some are not above any of them. But they start at the very top. The winner this year, no question, was energy. It was up 57% from January 1 to December 30. And the rest are in decline, mostly value stocks, healthcare, consumer staples, industrials, down single digits. And then it just goes on down to the very end, telecommunications, retail, and technology down at the bottom. This is the chart of the one-year chart on the S&P for the last 12 months. It goes up and down a lot, and my black arrow points out the general direction. The general trend is down. And last week was kind of a flat week, down a little bit, but for the S&P, but still below its 20-period moving average. Growth versus value. This is so interesting. Not surprising. And actually, when you go back to 2000, 2001, 2002, very similar to that. And not so much in 2008, because value stocks got hit more in 2008. But in 2000, growth stocks got hit. And that's certainly happening this year. So if growth stocks are the numerator, value stocks denominator, if it goes up, that favors growth. If it goes down, it favors value. So you can see the degree to which value stocks are dominating the market. And when I looked, just previous slide, at healthcare, consumer staples, and industrials, all value type index or value type sectors, same story. When I do the relationship of small cap to large cap, IWM, the Russell 2000 Small Cap Index, ETF, and SPY, for the largest 500 companies, that relationship of small to large, if it goes up, that favors small companies, and you can see at the very beginning of the chart it did, and then it went against small cap companies. And then now, for most of 2022, the is gradual incline going up, but mostly kind of flat. That there's not a lot of difference, relatively speaking, in small cap and large cap. This is not a relative chart. This is an absolute chart, and it bears out what I was saying before. The decline well into the 40%, 40 plus percent, I think it's 46% decline from its peak for TLT, 20-year government bond, both back starting in 2020 and then a lot this year. But there are other kinds of bonds. I want to point this out: short-term, intermediate-term, corporate, high yield, high quality, different kinds of bonds. But all of them are subject to interest rates, particularly the government bonds, subject to interest rates. And you can see the direction that they're going down. And at the very end, the drop-off at the end, they had a bad week, a bad couple of weeks. So they went from a value of, I don't know what it is, about 105 or 6 down to 99. The dollar continues to weaken. It rose quite a bit and now is on seemingly a trajectory down. Looking at that chart, I would say it's got more down left in it, but it was, I don't know why it was up, but it was. Gold has been moving up, and you can see that at the end. This is from, what is that, mid-October to today, so 2.5 months, moving up. And then this is silver moving up even more. So silver usually is an exaggeration of gold, both on the way down and on the way up. So it's moving up more quickly than gold, but they're both going up. When I chart that on a relative basis, putting silver as the numerator, gold as the denominator, you can see again, this goes back to late August, that silver has outperformed gold, or if it fell down, it has fallen less than gold. So on a relative strength basis, silver is definitely moving above the 20-period moving average and in an upward direction. Bitcoin going nowhere apparently. Still down, I don't know the number, 75% or so. Fallen from 65,000 to 16,000. And there are people saying it's going to go lower. Some say it'll go a lot lower. I don't know. But is this an alternative currency to the dollar as an insurance policy against the decline of the dollar? I personally don't think so. I prefer precious metals, but there are some people who think that Bitcoin is going to be that. The problem that Bitcoin had, if we go into a depression or an extended recession, et cetera, equities go down further. That seems to be a case can be made for that. Bitcoin is likely, highly likely, to continue to go down. It is not a safe haven, and we saw that this year. Bitcoin collapsed with the market, and so generally speaking, so I don't see it as something that's counter-directional. You'd look at gold and silver, they go up and down. They're manipulated, I acknowledge all that, but they are a safe haven, they're a store of value, and they're an alternative asset to paper currency. Asbury Research does their data, publish their data, and this is their 6 major metrics that they use, and all 6 are negative pretty much as of Friday. A lot of indicators, and were all negative because the month was a month in decline. The month was down about 6% on the S&P, and finished kind of on a down note. So, okay, cross-asset relative performance. This is taking ETFs and each asset group and comparing, or sector type of stock, and comparing them to another. So the ones that stand out are the ones that have green boxes all the way across. Low volatility stocks, that would probably be more like value stocks, compared to high volatility, high beta stocks. Low volatility is in favor. And if you looked at that chart that showed the ratio of value to growth, that would support this. Blue chips versus the broad market, the S&P. Blue chips meaning the Dow, meaning value. Blue chips clearly in favor. Again, the same data point. The broad market, the S&P 500, compared to the NASDAQ, broad market. So whether it's the Dow or the S&P, they both have done better than the NASDAQ. And same thing, growth or value, of course, value. Developed countries versus the U.S. Developed countries are doing better than the U.S. when measured by SPY. And emerging markets, they don't have all three of them, but they have 2 out of 3. Even they have done better than the U.S. in the last month and the last quarter. U.S. versus the world. The U.S. still does not have a single green box. It is not dominant over any country enough to get a green box for the last week, the last month, the last quarter. So you see Europe is in here, developing countries, developed countries, all doing better than the U.S. But in the first column, the weekly, you are starting to see the U.S. come in some. So not strong, but it's at least making the scoreboard. I took the developed countries ETF, EFA, and created a relationship with SPY. SPY, S&P 500, being the numerator, and developed countries being the denominator, EFA. And this is what the chart looks like. So you can see the degree to which developed countries are more in favor. The degree of the drop means developed countries are better than the U.S. from a stock perspective. Volatility index, this is a 12-month chart. It goes up and down a lot, and the more it goes up, the more it favors volatility and risk in the market, if you will, and the more it goes down, it favors diminished volatility or more stability in the market. So the line I put at 24 is kind of a benchmark to see we're still below that line, but we do have a tick up. So I'd say it's still relatively positive at this point. And we'll have to see further, but since it dropped below there, below 24, it has stayed below 24. Okay, gold and silver, as of Friday, December 30, gold was $18.28 an ounce. That's the spot price. Now they charge a premium on top of that. That varies. I don't have a current read on it. I think it's around $100 an ounce. And silver, excuse me, silver is at 24.08, and that's up 1% from the previous week. As I showed in the chart, continuing to increase in value, increase in price, and the markup on that is around $5. Again, I'm not a dealer, so I'm not being exact. I'm just giving you an approximate number, but I think something in the range of $5 is fairly common. So, what is this, Old Man Winter says, I'm not going out there. You go out there. So, stepping into 2023, I don't think people who have been had a hard time in the market this year, and maybe with other areas too, maybe with health or with other aspects of their lives, have want to step into 2023. Maybe people are going in kind of more hesitant, but hopefully it's going to be a good year. I think it'll be mixed. I think we'll have quite a bit of down. I think we'll have quite a bit of up. And what order and when, nobody knows that. So, but I think we'll see both sides of the market this year. And I think it'll be better, and it'll be definitely different. 2022 was so unusual from an investing perspective and from a market perspective. very unlikely that that will repeat itself anytime soon, and certainly not on a back-to-back basis. I just don't see it. So I should stay away from predictions, but I would think that would be a safe one. Okay, have a happy new year. And if you have questions or comments, leave them in the comment section below. I will try to answer them.